Chapter 6. Focus on the enterprise. Seek simplicity and distrust it. Anonymous. Simplifying our life is a great thing to do. Those of us who have cleaned out a garage, wardrobe or bedroom of junk accumulated over many years know what I mean. Perhaps some of these items were useful to us in the past. Perhaps they were never useful, but we thought they might be one day. Why is it a good idea to free us of unnecessary possessions? How can less be more? Well, removing unnecessary belongings allows us to focus our energy and attention on those possessions that can help us to do what we need to do. It is the same with financial statement analysis. Fundamental analysis of a firm is a lot of work. It requires time, energy, and effort. I do not know about you, but these are commodities that are in short supply in my life. The key benefit of simplifying our analysis is that it allows us to focus our efforts on those aspects of a business that are more likely to be adding value and to do a better job at analysing them. We've seen how in the DCF and economic profit frameworks that we can focus our efforts on analysing the enterprise, not the company. The enterprise is a firm's operations, the activities of a firm that add value without regard to how they are financed. We will see we do not need to consider how a firm has financed its operations if we think a firm is not materially adding value through its financing activities. In this chapter, we will see how in the economic profit framework we can focus on the abnormal earnings from net assets not at market value. This can be based on operating income after tax, OI, if net financial obligations, NFO, are measured in the balance sheet at market value. Also, we will see later in Chapter 7 that focusing on the enterprise, not the company, can have several significant advantages, including that we do not need to change the cost of capital with changes in leverage, and that we only need to focus on the risks of a firm's operations. In this chapter, we will also discuss price to book, PB ratios, for operations rather than for equity, and consider the relationship between levered company and unlevered enterprise ratios. We will see that levered company ratios are influenced by both a firm's leverage and its unlevered enterprise ratios. We will first look at how we can simplify the economic profit framework. 6.1 Economic Profit Framework. We saw in Chapter 3 that the economic profit framework can be expressed as value of equity equals book value of equity plus present value of abnormal earnings, i.e., if all the items in a firm's balance sheet are at market value, then the book value of equity could be expected to earn at the required rate of return. Abnormal earnings would be expected to be zero. Another way of saying this is the value of equity equals the book value of equity. This implies forecasted abnormal earnings, AE, equals zero. In principle, if the accounts could include everything at market value, then financial statement analysis would be totally straightforward. We could simply accept the book value of equity as equaling its market value. Unfortunately, this is not typically how accounting works. Even if some items in the balance sheet are at or close to market value, there will be others that are not. As we discussed in Chapter 2, accounting generally does not seek to capture estimates based on expected future economic and business events that may affect the firm's future earnings. And where it does, these will be subjective and open to potential manipulation or to various biases in their estimation. However, some assets and liabilities may have zero expected abnormal earnings, i.e., because they are measured at market value. We can express our economic profit framework as follows. Value of equity equals the book value of equity plus the present value of abnormal earnings from net assets not at market value. The reason we can safely exclude net assets at market value when calculating abnormal earnings, AE, is because, by definition, they will not contribute to abnormal earnings. All their value will be captured in the accounting book values. Different abnormal earnings measures. We have seen that restating a firm's financial statements can help us separate the earnings of a firm into operating income after tax, OI, and net financial expenses after tax, NFE. Earnings equals OI minus NFE. Restating a firm's financial statements can also help us separate the book value of equity into net operating assets, NOA, and net financial obligations, NFO. Equity equals NOA minus NFO. We can then separate abnormal earnings into abnormal earnings relating to operations and abnormal earnings relating to financial activities. First, we can see that abnormal earnings equals earnings minus ROE minus 1 times book value. This is the same expression as abnormal earnings equals ROE minus ROE minus 1 times book value, since ROE equals earnings divided by book value. Thus, abnormal earnings equals earnings minus ROE minus 1 times book value, which equals earnings divided by book value minus ROE minus 1 all times book value, which equals ROE minus ROE minus 1 all times book value. As we know, abnormal earnings are the additional or excess earnings over and above the earnings needed to earn the required rate of return on the book value of equity. This can be separated into abnormal earnings relating to operations, that is abnormal operating income, abnormal OI, and into abnormal earnings relating to financial activities, that is abnormal net financial expenses, abnormal NFE. Abnormal operating income equals operating income minus WACC minus 1 times NOA. Abnormal NFE equals NFE minus ROD minus 1 times NFO. You'll see we now have 3 different measures of the cost of capital. Cost of equity capital, ROE, cost of capital for operations, weighted average cost of capital, WACC, and cost of capital for debt, ROD. A different cost of capital is used for each measure of abnormal earnings, as the risks relating to each are different. The net financial obligations, NFO, of a firm are usually at or close to market value in a firm's balance sheet. This means that the abnormal earnings from NFO, that is abnormal NFE, can usually be expected to be at or close to 0. Value of NFO equals NFO plus present value of abnormal NFE. Thus, value of NFO equals NFO, where the present value of abnormal NFE equals 0. However, the net operating assets, NOA, of a firm are usually not at market value in a firm's balance sheet. This means that the abnormal earnings from NOA, that is abnormal operating income, can usually be expected to be material, either positive or negative. Value of NOA equals NOA plus present value of abnormal operating income. We also know that we can calculate the value of a firm's equity by deducting the value of a firm's NFO from its NOA. Value of equity equals the value of net operating assets minus the value of net financial obligations. This can be restated as value of equity equals net operating assets plus present value of abnormal operating income minus NFO, which equals NOA minus NFO plus present value of abnormal operating income, which equals book value of equity plus present value of abnormal operating income. Note, book value of equity equals NOA minus NFO. This is the enterprise economic profit framework. Do you see what has changed? The present value of abnormal operating income has replaced the present value of abnormal earnings. If a firm's net financial obligations, NFO, are at or close to market value in its balance sheet, then we can focus on abnormal operating income, abnormal OI, rather than on abnormal earnings, AE, which is after deducting net financial expenses. Or in other words, we can focus on the enterprise or operations of a firm regardless of how it is financed by equity or debt. A specific focus. We know that abnormal operating income, abnormal OI, equals the difference between a firm's operating income after tax, OI, and the required rate of return on its net operating assets, NOA. Abnormal OI equals OI minus WACC minus 1 times NOA. This can be restated as abnormal operating income equals return on net operating assets minus WACC minus 1, all times net operating assets, where return on net operating assets equals OI minus NOA. You'll remember we use subscripts such as little t or little t minus 1 to refer to the time period. If t equals 2021 and so t minus 1 equals 2020, then return on net operating assets 2021 would refer to return on net operating assets, RNOA, for the year 2021, and NOA 2020 would refer to closing net operating assets NOA in 2020, or in other words, opening net operating assets for 2021. In the formula above, we can see that the drivers of abnormal operating income are return on net operating assets, RNOA, cost of capital for operations, WACC, weighted average cost of capital, and net operating assets, NOA, put in place to earn the RNOA. We have taken a specific focus. Rather than considering both the operating and financial activities of a firm, we will now focus only on a firm's operating activities. We will focus on analysing a firm's return on net operating assets, RNOA, being the relationship of its operating income after tax, OI, to its net operating assets, NOA, and on the amount of net operating assets the firm has in place to earn that return. Now, a firm finances its net operating assets with equity or debt, or the terms on which it borrows or invests in net financial obligations or net financial assets, will be disregarded and considered to have no material impact on value. Rather, we will focus on a firm's operations, which are, after all, the total enterprise, the firm itself. In restating a firm's financial statements, we separate a firm's operating and financial activities and identify these key accounting measures of the enterprise of a firm: operating income after tax, OI, and net operating assets, NOA. The missing item, however, is weighted average cost of capital, or the cost of capital for operations. When focusing on a firm itself, rather than on the equity of a firm, we also need to focus on the opportunity cost of the capital required to fund a firm's operations, not the opportunity cost of the capital required to fund its equity. Cost of capital for operations. The operations of each firm will have their own unique risks. A firm will face potential risks, such as risks in its markets from the actions of competitors, customers and suppliers, risks from changes in technology, changes in customer tastes, changes in demographics, risks due to weather, general economic factors, exchange rate movements, changes in commodity prices, risks from changes in tax and regulatory rules and requirements, and many other types of risks. Businesses face uncertainty and risk in relation to their operations every day. Indeed, in business, there are risks at every turn, lurking under every rock. The risks of a business, relative to other investment opportunities, determine the return that someone would require to invest in the operations of a firm. This is a firm's cost of capital for its operations, or the cost of capital for the firm, that is, its weighted average cost of capital, WACC. This cost of capital is usually called the weighted average cost of capital, WACC, because it can be expressed as the weighted average of the cost of capital for equity and the cost of capital for debt. Weighted average cost of capital equals the value of equity divided by the value of the firm, all times rho E, plus the value of the debt divided by the value of the firm times rho D. This will be a familiar concept for those who have studied finance. The cost of capital for a firm's operations, or for the firm or enterprise, is weighted average cost of capital. The cost of capital for a firm's equity and debt, respectively, are rho E and rho D. Value of equity is the market value of a firm's equity at the end of period 0. VD is the market value of a firm's debt at the end of period 0, and VF is the market value of a firm's operations at the end of period 0. Weighted average cost of capital, rho E and rho D, are related to each other by a simple expression based on the proportions of the market value of a firm represented by the market value of its equity and by the market value of its debt, or in other words, by a measure of its gearing or financial structure. The cost of capital for a firm's operations, WACC, comprises the proportion of the market value of a firm represented by the market value of its equity multiplied by its equity cost of capital, plus the proportion of the market value of a firm represented by the market value of its debt, multiplied by its debt cost of capital. You'll notice that both equity and debt are at market value, not at accounting or book values. Also, the cost of capital for debt is usually the after-tax cost of debt, namely the nominal cost of debt multiplied by 1 minus T, where T is the firm's marginal tax rate. For example, if the tax rate is 30%, then 1 minus T equals 1 minus 0.3, which equals 0.7. Multiplying by 0.7 will reduce the cost of debt. This reflects the fact that a firm can deduct interest on debt from its earnings before calculating its taxable income. This will result in a firm paying less tax if it already has taxable income against which the interest can be deducted. Let us now look at how these different costs of capital interact. 6.2. Costs of capital interact. It is easy to think that the cost of capital for operations, or the WACC, is derived from the cost of capital for equity and the cost of capital for debt. After all, the formula indicates the cost of capital for operations can be calculated as the weighted average of rho E and rho D. Indeed, as I've already said, the cost of capital for operations is usually referred to as the weighted average cost of capital, WACC, in finance textbooks. However, this formula simply sets out the relationship between weighted average cost of capital, rho E and rho D. This same formula could just as easily be expressed as rho E equals the value of a firm divided by the value of equity times WACC minus the value of debt divided by the value of equity times rho D, or as rho D equals the value of the firm divided by the value of debt times WACC minus the value of equity divided by the value of debt times rho E. As you can see, rho E could just as easily be viewed as the weighted average cost of capital for operations, WACC and rho D, or rho D could be viewed as the weighted average cost of the cost of capital for operations, WACC and rho E. It is purely a matter of convenience to refer to the cost of capital for operations as the weighted average cost of capital rather than ROE or ROD. Source of risk. As we have seen, the familiar finance formula that shows the cost of capital for operations as the weighted average cost of capital does not imply that the weighted average cost of capital is derived simply from a weighted average of ROE and ROD, with the weighting depending on a firm's level of gearing. A moment or two of reflection should make this clear to us. Both the cost of capital for equity and the cost of capital for debt will be driven by the cost of capital for operations, by the risks inherent in the business, rather than the other way around. In determining their required rate of return, both providers of equity and debt capital will consider the risks of a firm's business or operations relative to the risks they would face with alternative investment opportunities. There is an interaction between supply and demand for capital in the capital markets, between the risks of a firm's operations and the requirements of providers of capital, based on the amount of capital they have and the risks of other investment alternatives they face. However, fundamentally, risk and the rate of return required to compensate providers of capital for assuming these risks comes from a firm's operations, not from the capital markets and not from anywhere else. Indeed, the cost of capital for equity could reasonably be derived from a firm's cost of capital for operations, rather than the other way round, and from its level of gearing, being a weighted average cost of capital based on the cost of capital for operations and the cost of capital for debt, as follows. ROE equals value of F divided by value of E times WACC minus value of D divided by value of equity times ROD. Or alternatively, since the value of the firm, value VF equals VE plus VD, this formula can be re-expressed as ROE equals the value of equity plus the value of debt, all divided by the value of equity times WACC minus the value of debt minus the value of equity times value of debt divided by the value of equity times ROD equals WACC plus value of debt divided by the value of equity times WACC minus the value of debt divided by the value of equity times ROD. Thus, ROE equals WACC, the weighted average cost of capital, plus the value of debt divided by the value of equity, all times WACC minus ROD. Equity risk and the equity cost of capital can be seen to have two components: operational risk, weighted average cost of capital, and financial risk, comprising leverage, value of debt divided by the value of equity, and spread, weighted average cost of capital minus ROD. Effective leverage. Let us illustrate this relationship by using it to calculate the equity cost of capital for Ryman Healthcare. If we take the view that as a result of its operational risks, the cost of capital for operations of Ryman Healthcare is 8%, and that its cost of capital for debt, ROD, is its net borrowing cost, MBC, which is 0.4%, which is particularly low for Ryman Healthcare as it has a large amount of non-interest bearing occupancy advances in its liabilities. Let us also take the view that the market value of debt for Ryman Healthcare is the book value of its net financial obligations as at 31 March 2021, which is $2,287.1 million, and that the market value of equity, VE, for Ryman Healthcare is its market capitalisation of $7,650 million, based on a share price of $15.30 per share at 31 March 2021, and multiplying it by 500 million shares. Then we can calculate Ryman Healthcare's equity cost of capital as follows. ROE equals WACC plus the value of debt divided by the value of equity, all times WACC minus rho D, which equals 8%, plus 2,287.1 divided by 7,650.0, all times 8% minus 0.4%, which equals 8% plus 0.3 times 7.6%, which equals 8% plus 2.3%, which equals 10.3%. This now brings us to an interesting and critical point. As the leverage of a firm increases by increasing the amount of debt relative to the amount of equity funding a firm, the required rate of return on equity will increase, given the required rate of return on operations is greater than the required rate of return on debt, that is, the spread is positive, and that the required rate of return on debt does not change as leverage increases. For example, if we increase Ryman Healthcare's debt on 31 March 2021, that is at the end of year 0, from 2,287.1 million to 4,574.2 million, that is double it, then we can calculate Ryman Healthcare's equity cost of capital as follows. Rho E equals WACC plus value of debt divided by value of equity, all times WACC minus rho D, equals 8% plus 4,574.2 divided by 7,650.0, all times 8% minus 0.4%, which equals 8% plus 4.36%, which equals 12.6%. We've seen that a firm's return on equity can be increased by increasing leverage if the operating spread between return on net operating assets and NBC, net borrowing cost, is positive, and net borrowing cost does not change with increased leverage, as follows. Return on equity equals return on net operating assets plus FLEV times spread. Return on equity equals return on net operating assets plus net financial obligations divided by equity times return on net operating assets minus net borrowing cost. You'll notice that the items in this expression are accounting measures, not market-based measures. We've seen in Chapter 4, Section 4.1 that in 2021 these figures for Ryman Healthcare were, and I include them all in the reading, and it comes down to ROE equals 24.9%. If we increase Ryman Healthcare's debt on 31 March 2021 from 2,287.1 million to 4,574.2 million, that is double it, we can calculate Ryman Healthcare's return on equity as follows. So I've got the numbers there in the reading. Return on equity equals 31.2%. How much a firm is financed by debt or by equity will affect both the required rate of return or cost of capital for equity and the accounting return provided to equity investors in a firm. In our illustration above, increasing debt increased ROE from 10.3% to 12.6% and increased return on equity, ROE, from 24.9% to 31.2%. If both measures of spread are positive and are unaffected by the change in leverage, increasing leverage will increase both the return on equity provided to equity investors and their cost of capital or required rate of return. Using an economic profit framework, increasing return on equity will increase the value of a firm, and increasing ROE will reduce the value of a firm. If these two effects of leverage exactly offset each other, then the financing of a firm between debt and equity would have no net effect on the expected future abnormal earnings of a firm and have no effect on the value of the equity of a firm. This would be consistent with the theorems proposed by Modigliani and Miller that under certain circumstances the financing of a firm has no effect on its value. Under certain circumstances, there would be no ability for a firm to add value for equity investors through its financing activities. In such circumstances, any increases in return on equity (ROE) achieved through increasing financial leverage would be exactly offset by the higher cost of capital for equity required by equity investors. A simplified illustration. Let us explore this idea a bit further by considering a simplified view of the future for Ryman Healthcare. It is simplified because most firms are complex, with their many aspects continually interrelating and affecting each other. A key skill in business and in financial statement analysis is to understand a firm's key drivers out of all this complexity. This can sound easy to do, but it is not. Simplicity and focus are great strengths, but they can also drive you onto the rocks or get you into trouble if in focusing on a few key things you take your eye off one or more other things of importance to a firm. Both business and financial statement analysis can involve the twin skills of cutting through complexity and messiness and focusing relentlessly on the key drivers of a firm, while also having eyes in the back of your head, being constantly aware that there may be aspects of a firm and its environment you are not on top of, and that may come at you when you least expect it. There is very little in the world that continues unchanged forever. However, let us take the view that certain aspects of Ryman Healthcare's financial performance and financial position as reflected in its 2021 financial statements continue unchanged forever. No doubt Ryman Healthcare's operations will undergo substantial change in future years. However, let us think about the situation that its 2021 operating income after tax (OI) of $647.6 million and its 2021 net financial expenses after tax (NFE) of $8.8 million continue unchanged each year into the future. Let us also take the view that its 2021 net operating assets (NOA), net financial obligations (NFO), and equity stay unchanged each year into the future. We know that Ryman Healthcare is reinvesting its substantial operating cash flow into new net operating assets (NOA), developing new and extending existing retirement villages. However, let us think about the situation where all this development activity stops and Ryman Healthcare's free cash flow (FCF) is instead paid out as dividends each year. This is a 2021 steady state view of Ryman Healthcare. Let us also take the view that because of its operational risks, the cost of capital for operations, WACC, of Ryman Healthcare is 8% in 2021, and this continues unchanged each year into the future. The purpose of this simplified illustration is to help us get a feel for the relationship between a firm's financial activities and its equity cost of capital, ROE, and ROE, return on equity. This is central to understanding how the various costs of capital interact and the extent to which a firm can or cannot add value for equity investors through its financial activities. Based on a cost of capital for operations of 8%, the abnormal operating income of Ryman Healthcare each year in the future can be calculated as, and the calculation shown, abnormal operating income equals $281.5 million. We know that the economic profit model suggests we can value the equity of a firm as follows. Value of equity equals the book value of equity plus the present value of abnormal operating income. If we expect Ryman Healthcare to earn abnormal operating income of $285.5 million forever, or for eternity, then we can value the present value, PV, of its abnormal operating income as if it were a perpetuity of $281.5 million, discounted at the cost of capital of operations WACC of 8% per year, which would equal abnormal operating income divided by weighted average cost of capital equals $281.5 million divided by 8%, which equals $3,538.8 million. The value of Ryman Healthcare's equity would equal its book value in 2021 of $2,829.2 million plus $3,538.8 million, that is $6,368.0 million. As Ryman Healthcare has 500 million shares on issue, this would represent a value of about $12.75 per share. Similarly, we can value Ryman Healthcare based on a valuation of its abnormal earnings. We can calculate Ryman Healthcare's cost of capital for equity as follows. ROE equals, and I show the formula and work through the numbers, and come to 10.4%. You will see I have used the average book value of the firm's net financial obligations as adequately representing its market value, and have used our measure of the market value of Ryman Healthcare's equity, $3,518.8 million, from our calculations using the economic profit framework. Ryman Healthcare's comprehensive income, CI, of $252.7 million each year represents a return on equity of 24.9% each year, based on the book value of shareholders' equity of $2,565.1 million. The abnormal earnings of the firm are calculated as abnormal earnings equals return on equity minus ROE minus 1 all times book value, which equals 24.9% minus 10.4% all times $2,565.1 million, which equals $372.1 million. The economic profit model suggests we can value a firm's equity as follows. Value of equity equals the book value of equity plus the present value of abnormal earnings, AE. If we expect Ryman Healthcare to earn abnormal earnings AE of $323.2 million forever, or for eternity, then we can value the present value, PV, of its abnormal earnings AE as if it were a perpetuity of $323.2 million, discounted at the equity cost of capital of 12.3% per year, which would equal abnormal earnings divided by ROE, which equals 372.1 divided by 10.4%, which equals $3,549.2 million. The value of Ryman Healthcare's equity equals its book value in 2021 of $2,829.2 million plus $3,549.2 million, which is $6,378.4 million. As Ryman Healthcare has 500 million shares on issue, this would represent a value of about $12.75 per share. In this simplified illustration, the economic profit valuation of Ryman Healthcare using discounted abnormal operating income and the valuation of Ryman Healthcare using discounted abnormal earnings, AE, provide the same value after allowing for rounding for Ryman Healthcare, namely about $6,378.4 million or $12.75 per share. How is it that we can value a firm using discounted abnormal operating income or discounted abnormal earnings, AE, and arrive at the same value for its equity? The reason is that in our example, the firm's net financial obligations is at market value, or in other words, abnormal net financial expenses equals 0. We will next have a look at the impact of a firm's leverage and other factors on its earnings growth.